The Income Tax Bill 2025 brings a comprehensive overhaul to India's taxation system, with 536 sections, 23 chapters, and 16 schedules. While it has a higher number of sections than the previous Income Tax Act, 1961, it is actually shorter in length due to the removal of complex explanations and provisos. The government has focused on simplifying the law to make it easier for taxpayers to understand and comply with. One of the major changes introduced in the bill is the concept of the tax year, replacing the earlier system of the previous year and assessment year. Many taxpayers used to get confused between the financial year, assessment year, and tax filing deadlines. With the introduction of a single tax year, the compliance process is expected to become clearer for individuals and businesses. This simplification will help ensure that taxpayers file their returns correctly without misinterpretation. In an effort to support businesses and professionals, the turnover limits under Section 44AD and 44ADA have been increased. For businesses opting for the presumptive taxation scheme, the turnover limit has been raised from 2 rupees crore to 3 rupees crore. Similarly, for professionals, the limit has been increased from 50 rupees lakh to 75 rupees lakh. This change provides greater flexibility for small businesses and professionals, reducing their compliance burden. Additionally, the bill encourages digital transactions by offering audit relief for businesses with a turnover of up to 10 rupees crore, provided at least 95% of their transactions are digital. The tax audit deadlines have also been extended to provide additional time for compliance. There were speculations that the scope of tax audits might be extended to include company secretaries, CS, and cost and management accountants, CMA, but the bill has retained this function exclusively for chartered accountants, CAS. As per Section 515(3)(b), the term accountant is explicitly defined as a chartered accountant, putting to rest any doubts regarding the role of other professionals in conducting tax audits. This decision has brought a sense of relief to the CA community, reaffirming their exclusive authority over tax audits. When it comes to capital gains tax, there are no changes in the tax rates or classification. Long-term capital gains, LTCG, and short-term capital gains, STCG, taxation remain the same as last year's provisions. This ensures continuity for investors and traders in the stock market, avoiding any sudden tax liabilities. However, the bill does introduce greater clarity on the tax treatment of stock options, ESOPs, to reduce tax disputes. The provisions for deductions from salaries have been reorganized for simplicity. Standard deduction, gratuity, and leave encashment benefits, which were previously spread across multiple sections, are now tabulated in one place for better clarity. Similarly, the computation of depreciation for businesses has been simplified with a clear formula, making it easier for businesses to calculate their depreciation claims. Tax deducted at source, TDS, provisions have also been consolidated under one clause, with simple tabular formats to improve understanding. While this streamlining makes the law easier to interpret, it also means that once the bill is implemented, significant changes will be required in tax reporting forms and software systems to align with the new structure. The bill is set to become effective from April 1, 2026, meaning that tax computations for financial years ending in March 2025 and March 2026 will still follow the existing Income Tax Act, 1961. This transition period gives taxpayers and businesses time to adapt to the new provisions. A major shift in the new bill is the delegation of certain powers to the Central Board of Direct Taxes, CBDT. Currently, many tax schemes, procedural changes, and compliance frameworks require parliamentary approval before implementation. Under the new law, Clause 533 empowers the CBDT to make tax rules independently, reducing bureaucratic delays. This will allow faster implementation of new tax policies, making governance more efficient and adaptable to changing economic conditions. The CBDT will now have the authority to introduce compliance measures, digital tax monitoring, and administration rules without needing frequent legislative amendments. One of the most notable changes in the bill relates to virtual digital assets, VDAs, such as cryptocurrencies and NFTs. The bill retains the flat 30% tax on income from VDAs, with no deductions or exemptions allowed, except for the cost of acquisition. Additionally, the 1% TDS on crypto transactions remains applicable, ensuring proper tracking of digital transactions. A new provision has also been introduced to count virtual digital assets uncovered during tax searches as undisclosed income. Previously, only money, bullion, and jewelry were classified as undisclosed income when detected in raids. Now, any unreported cryptocurrency holdings discovered during investigations will also be taxed heavily, bringing crypto transactions under strict regulatory oversight. These changes highlight the government's intent to tighten regulations on digital assets, ensuring that all sources of income, physical or digital, are properly declared and taxed. Crypto traders and investors must now be extra cautious with their reporting, as the tax department will use AI-driven scrutiny and digital tracking to detect unreported digital assets. With all these updates, the Income Tax Bill 2025 marks a significant transformation in India's tax framework. It simplifies compliance, streamlines deductions, introduces modern digital governance, and enforces stricter penalties for tax evasion. The shift towards AI-based monitoring and faceless assessments ensures that tax compliance is transparent and efficient. The new law is expected to make tax filing easier for individuals, while businesses and investors must stay updated with the latest changes to avoid penalties and ensure proper reporting. The delegation of powers to CBDT, the clarification on ESOP taxation, the audit limit increases, and the focus on digital transactions all point toward a more structured, technology-driven tax system in the coming years. As India transitions to this modern tax regime, staying informed about these changes is crucial for every taxpayer. If you found this information useful, don't forget to like, share, and subscribe for more updates on finance and taxation.